Historically, companies were a very usual instrument in this area. At the time, in the 70s, in the 80s, there were huge tax benefits from buying properties in offshore companies. It was a way not to pay taxes in case of a sale. Obviously, times have moved on. Everyone pays tax on their purchases and on their sales. And even though those benefits are not there, for historical reasons, companies have remained in the market. We had serious changes in Portugal in 2003 when a blacklist was brought into our system that companies domiciled in certain jurisdictions were being charged significant taxes on council rates or when acquiring a property. So the market readjusted. We advised our clients to move their companies to other jurisdictions that are not included in the blacklist. And because these companies have been here historically, people continue to carry out transactions with them. We do see now a new wave of development of these companies. More and more they're becoming Portuguese. So not only are people still buying in companies, new companies that will be Portuguese, as they are changing the head office of companies that already existed to Portugal. For various reasons, it's difficult to keep up with compliance in a country where the owners may have no relationship with. They won't know the professionals that are providing the services in those jurisdictions, and having it in Portugal also reduces the running costs because the clients can be the shareholders, they can be the directors, they just need to have an accountant to file the accounts in Portugal. So it simplifies. So we've seen these companies come into the market mainly through the British market. The British investors from the 70s, the 80s, they still remain in the market. In 2003, we saw them being redomiciled to jurisdictions that comply with the Portuguese system. And we now see them re-enter the country as Portuguese companies, making the whole thing more transparent. The clients feel happier that they have a Portuguese company in the country where their properties are. The advantages of purchasing a property in an individual name or privately are that the process is much more straightforward. Of course, we'll have to register the purchaser in the Portuguese tax department, obtain a Portuguese taxpayer number, a few things like that. But when it comes to the purchase, we only have to worry about the property. So we do our thorough due diligence on the property, prepare the promissory contract and the Portuguese law. There will be the payment of purchase costs. So there will be stamp duty, there will be transfer tax, we will sign a deed, we will register the purchase in the land registry department. Obviously, because it is an individual name, all the utilities will have to be updated to the name of the individual. If it is the purchase by a couple, normally there's only IMI to pay and no additional IMI. At time of sale, there are some advantages as well, particularly if the vendors decide to become resident in Portugal at some stage, because in that case, they can actually roll over the proceedings of the sale into another property, not only in Portugal, but in the EU, and with that, save capital gain tax. If, on the other hand, they're resident in another country, tax will be paid in Portugal at half the tax rate of their home country, and then they declare in their country of residency that that tax has been paid in Portugal. So corporate purchase, the main advantage is that most of the time you avoid purchase costs. The only circumstance when you don't avoid purchase costs is if you're buying a Portuguese company and one of the shareholders is more than 75%. Do note that a couple counts as one shareholder. Now, that is a big advantage because there's no stamp duty nor transfer tax. So it's a big advantage. Then there is another big advantage that all your running costs are taken into the company's books. So if you pay your electricity bill, your water bill, your gardening, housekeeping, that can all be registered in the company's books. So ultimately, shareholders' loan that you can offset at time of a sale. They're not lost. Those costs are lost when you buy in your individual name. Companies also give you more flexibility in terms of restructuring your assets. So that's also a good advantage. Buying through the company does mean you will have to pay additional IMI, not only IMI. So that is a disadvantage. There will be annual costs with running the company. If it is a Portuguese company, you'll have to have an accountant, you'll have to file accounts. If it is domiciled abroad, depending on the jurisdiction, you may have to file accounts as well. And there will definitely be management fees with the upkeep of the company. The purchase process is not as straightforward because obviously we add to the due diligence on the property, the due diligence on the company, which is very thorough. We check the companies from incorporation until sale time, absolutely everything. So although the jurisdictions more commonly used in the area are of English-speaking countries, so the clients can also follow our due diligence. We do reports. Everything is actually in English and very easy to follow. There are quite a few documents to examine. So it's a more complex purchase and sale, but with quite a few advantages. There is something else to take into account when buying a company, that the historical value of the property may be low. So there may be an embedded liability of CGT, of capital gain tax in the company, that despite all the advantages of corporate purchase needs to be taken into account when making a decision. So we've discussed the advantages of buying through a company. There is the other side when you're exiting. If you've bought a company, what happens at time of sale? Obviously, you have two options. You can sell the company or you can sell the property. The company can sell the property. So transfer of shares of a non-Portuguese company, of what we call a white-listed company, is taxed in Portugal at 28%. The double taxation agreement with some countries exempts the payment of that tax in Portugal. For example, for UK tax residents, they pay tax on the transfer of shares back in the UK. The rate that applies in Portugal is 28%, as I said. If the vendor is an Irish tax resident, they'll have to pay the additional in the UK. If the vendor has a lower rate in their country of residency, they will pay the 28% in Portugal. The alternative is that the company sells the asset. So if the company sells the asset, we have a flat rate of 25%. If, on the other hand, the company is a Portuguese company and there is a transfer of shares, most of the companies that own properties qualify as a small company. And as a small company, the CGT tax, the capital gain tax on the transfer of shares, is only 14%. If the rate in the country of residency of the vendor is actually higher, they will have to pay the additional in their country of tax residency. If it is the Portuguese company that sells the asset, the Portuguese company will be taxed at IRC, corporation tax in Portugal, currently at 21%. It's becoming more and more common that we're bringing them to Portugal. For reasons that we've discussed. We bring them into Portugal because we reduce the costs, the shareholders have more control, so we do see quite a few clients wanting to do that. They can also bring them to their own countries. Some countries don't allow exit of companies. Portugal does. So if we redomicile a company, say from Delaware to Portugal, and the client then wants to take it to Belgium or Ireland or the UK, we can do that. There is no exit tax in Portugal. And buying an offshore company does have all the benefits of a corporate ownership, using all the costs, the housekeeping, the gardening maintenance, all of that. That all becomes a cost for the company and potentially a shareholder's loan. At time of sale, it can be quite interesting. It depends on the vendor's country of tax residency, but we have had a court decision by EU court before the end of last year that said that the tax rate applicable to the sale of a small company should be taxed by the Portuguese authorities the same way the sale of a Portuguese company, small company, is taxed. So if a Portuguese small company is sold, the tax on the gain of the sale of the shares is taxed at 14%. The Portuguese government has been taxing the sale of shares of an offshore company at 28%. So this will revolutionize that. If the vendor is resident in Portugal, the rate will now be 14%. This still has to be recognized by a Portuguese court, but it's imminent, and we can actually request a return of tax that has been unduly paid, but it is a serious reduction on the capital gain tax rate. Obviously, if the vendor is resident in Ireland, he will have to pay the additional up to 33%. If he's resident in the UK, he will have to pay the additional up to 20%, which is currently the rate in the UK. So it depends on the country of residency of the vendor, but it is a big change if this rate indeed is dropped from 28 to 14%. So all in all, it's definitely a field with a lot of good opportunities to make a good investment.